So welcome again, everyone. Happy to have you join us this afternoon, and a big thank you to Dimitri, Raziev, and Brian Kane for joining us on the webinar today. Today we'll be taking some time to talk through the future of B2B payments and financing, and specifically what we're going to focus on today is a few different elements. So first we'll start with some welcome and introductions. And then, we'll jump into some of the key topics that are most germane to what we're seeing today, especially for small businesses, medium-sized businesses, and investors. So we'll start off by going through first the current economic landscape, talking a little bit about how business leaders and investors as well are responding, and then having a closer look at the private debt and direct lending and opportunities for SMEs as we go forward. So I'm pleased today to be joined by two towering figures in their respective industries. We have Dimitri Raziev, the CEO and co-founder of Kolleno. So Dimitri spent several years prior to founding Kolleno across a number of the leading banks, working various roles at Goldman Sachs and Credit Suisse. And so, Dimitri, maybe I'll hand it over to you just for a quick introduction to the participants.
Hi, Gibran. Hi, Brian. Thank you very much for the short introduction. So currently, we're obviously building Kolleno. It's a cash acceleration tool for mid-sized to enterprise companies, helping companies in terms of performing cash credit insights and understanding how they can accelerate late payments. So this is what we do at Kolleno, and looking forward to have this in-depth conversation with Brian on the economic overview on a debt capital market itself. And then I'll let also Brian to introduce himself.
Thank you, Gibran and Dimitri, and thanks for the invitation to speak today. So basically, I am Director of Capital Markets and Origination at Crosslend. So Crosslend is an institutional platform that allows institutional investors to log on and access direct lending, private credit funding opportunities. So these are typically funding opportunities from 10 to 150 million. And Crosslend, which grew up in the Berlin digital tech ecosystem, basically we digitally integrate with originators, essentially standardizing all of their historic loan level information and payment data and performance history, which allows the investors the ability to analyze these opportunities and determine if this is something that they would like to invest in. Separately, we have an analytics business, and we also have a funding platform based in Luxembourg, where we've executed close to 30 transactions to date. So my experience prior to that, I was head of capital markets for a UK non-bank financial, and I spent 17 years with Standard & Poor's, the credit rating agency, working on UK and European structured finance transactions across many, many different asset classes.
Perfect. Thank you, Brian. And just for the participants on the line, myself, I will be a moderator today. My name is Gibran Larabir, and I'm Chief of Staff here at Kolleno. So glad to have everyone on board. So maybe what we'll do to kick it off is just talk a little bit about the current economic landscape. I think through our conversations with a number of different CEOs and CFOs and business leaders and investors, I think the current economic landscape is definitely top of mind, and I think we've seen some announcements in recent days that have really brought this to the fore for a number of business leaders. And so if we're taking a look at the current uncertainty around the economy globally, in the UK, Canada, US, and other parts of the world, I think there are a few things top of mind really for a number of business leaders. And I think first and foremost is the inflationary pressures, right? Starting to see some rising prices, a number of rising prices for goods and services that are really putting some strains on businesses and consumers alike. I think the second is really around, the supply chain constraints that we're seeing in the market at the moment. So really, limitations in some of the supply chain that's leading, to lack of certain, goods and services and also some rising prices in that sense. And then, geopolitical tensions, labor shortages, especially, in this kind of post-pandemic or the new normal kind of world, and of course, rising interest rates, which I think is top of mind for a number of businesses and business leaders and investors, as we see rates increase in the US recently, the UK, Canada. And so, given this context, how are business leaders able to respond? What's top of mind for these leaders? What is, how are these leaders responding, and what are some opportunities? And that's what we really hope to dive into today with the audience.
Thank you, Gibran.
No problem. And I think, in light of these economic pressures, just before we dive in, and we'll do, much more of a Q&A with Dimitri and Brian, I think in light of these economic pressures, I think business leaders are really continuing to optimize their operations, I think through increased digitization and digital tools. And they're also looking at two different elements. I think the first thing that's top of mind for business leaders is, how do we improve our cash flow and working capital as we try to position ourselves for, the coming months, the coming year. And I think secondly, it's really to ensure access, right, to capital and to fortify operations. And so I think with that, maybe Dimitri, I'll kick it off with yourself. I know that you make it a priority to talk to 2 to 3 CEOs or CFOs a week. From these conversations, what are you hearing? What's top of mind for these leaders?
Thank you, Gibran. There's a number of things that are really on top of mind of CFOs and business leaders. There's 3 things that comes across the conversations that we had over the last 12 months and the last few weeks especially. The first one is really related to working capital. So a lot of CFOs are concerned be able to fulfill the payments to their suppliers. So this is something that always comes to the conversations that we have, and this is increasing the level of the gap between receiving cash flows and the cash flow that comes out of the balance sheet. So most of the concerns is also receiving payments for their clients. So this is often the discussions that is highlighted across the financial directors and business leaders that we're discussing within the treasury division of businesses. The second really core element is when it comes to retaining talent. I think talent is also in a very inflationary environment. Salaries has been getting adjusted for inflation. So there is a high pressure on recruiting talent, but the price adjusted salary talent. So this is something that we're seeing where CFOs are looking for a specific niche talent that they can fulfill the positions within their divisions. And then the last one, but not the least, is really be able to sustain those operations while be able to fulfill their working capital, be able to do the right purchases, deploy the right strategies, and sustaining operations at the macro level and also at the micro level. So this is primarily those 3 elements that are always very recurrent. The first one is the working capital needs. The second one is really retaining talent and recruiting for new talent, especially in the environment where people are either working from home or becoming more digital nomad. And then the third one is be able to sustain operations and navigate through those economic uncertainties.
So Dimitri, given those 3 elements that you talked about, the working capital, growth, and talent, how are business leaders responding? What are some of the trends that you're seeing?
I think one of the trends that we're really seeing from the beginning of this year is that large corporates, 250 to 200 million above revenues, were very quick to adapt themselves in terms of digital transformation. So there's an acceleration. They were able to deploy tools like Slack, Zoom, or even Jira across companies, and able to communicate cross-divisional and aggregate all their employees under one single umbrella and technology to communicate and exercise their day-to-day operations. And what we start seeing is that obviously smaller companies on the SME side or mid-sized companies were lagging behind. And we've seen this trend in particularly in the legal industry, where they haven't embraced this speed and acceleration of digital transformation when it comes to their day-to-day operations. So this is basically, we're seeing this shift, obviously in the logistics space as well, and in the transportation and construction. And then I think the good thing is that business leaders are realizing the importance to move towards to a one centralized platform that allows to normalize all the communication or normalize all the duties across different divisions and different individuals within a company. So smaller companies are beginning to embrace digital transformation, which was not the case several years ago. But certain industries are lagging more behind.
And Brian, just off that, are you seeing similar things from your conversations with business leaders and investors at Crosslend? What are some of the major market trends that you guys are following?
Yeah, so we deal with originators and investors, and we also deal with large banks who are looking to upscale and digitize their own processes. And I guess, one broad comment is everyone is aware we're almost living in a perfect storm at the moment of factors that are affecting, business and finance and all parties in the market. And it's a long list, geopolitical issues, inflation, supply chain as a result of COVID, interest rates, funding costs, the energy cost increases. And, this is leading to a more cautious environment where investors, I think, are being a bit more cautious about the expectation on the performance of underlying receivables, potentially how it would impact default rates, and, very keen to monitor things like credit deterioration. Obviously, the central banks of the world, notably in the UK earlier today, we had a 0.5% increase in interest rates. So central banks have taken extraordinary measures to dampen down inflation. And, I think that this is clearly the right thing to do because, if inflation continues to take hold, it basically results in higher prices, higher labor costs. So, what the measures, the monetary measures that the central banks are taking is to basically increase the cost of money and take capital out of the economy to basically try and kind of reduce the demand from consumers to acquire things. I think there's also a sense that perhaps a lot of the stimulus that had come in post-COVID had to some extent contributed to that inflation. So, there was clearly a lack of spending during that, and there was a lot of savings. So I think generally people feel that on the hydrocarbon side, the oil and gas prices may have peaked, and also that inflation, touch wood, may also be peaked. The increases may be peaking also. However, notwithstanding that, I think that the challenge is what will the target inflation be over time? The Bank of England and general economies tend to target 2% inflation. So the question is, how do you manage the economy to that level? But generally, I think that we live in a world of constant change. The last couple of decades has shown that businesses and business leaders have to adapt to a lot of different things, whether it's the Greek, national debt crisis or COVID. And I see this just as another one. But I think the difference here is, and one of the positive things is and I think this echoes what Dimitri has said from what he is hearing, is the acceleration of the adoption of digitization. So there's a clear trend that companies are basically making investments, and they recognize the need to basically be more efficient and use technology as part of their businesses and their business planning going forward as they continue to grow. So we're definitely seeing that in the funding space as well.
Mm-hmm. And given all of the what you just talked about in terms of some of those key factors, what are some of the impacts that you see specifically for the private debt market?
Yeah, so once again, there are positives and negatives. So private debt and private credit as an asset class has grown kind of at a phenomenal rate in recent years, and that's largely driven by the continued absence of banks, in terms of funding what the kind of the economy needs, because banks have after the financial crisis became very much over-regulated and became very conservative, very concerned about concentration risks and all those other things. So what you saw is that a lot of asset managers and investors grew to recognize that there was an opportunity to directly fund assets in the real economy. So, and this is, I very much see Europe as being about 6 years behind the US. The US economy has very much embraced kind of direct lending and credit, and we're seeing very much a catch up here where there are a lot more investment providers in this space. So the first thing is there will be a lot more providers providing capital in the space over time. At the moment, I think those investors are looking for opportunities that give good yield, but also they're looking to cherry pick the low hanging fruit. So those companies that demonstrate they have good sound business models. And also, they're very good with data. They want to see that they have the capability of handling the business, and also managing cash flow and liquidity. So, to some extent, you're seeing investors being hands off and they're risk off. And part of that is that they're focusing on their existing portfolios, the businesses that they have, or the deals that they funded to this date. But we are seeing things thaw a bit, and there's continually interest to fund invoices, which is a good thing. And I think there are more and more platforms that are there to do that. I think the other thing to remember is that, that because of the 2008 crisis, from a kind of a fiscal and a monetary perspective, the agencies of the state have become a lot better at kind of managing crises. So, and this could be from the ECB, the Bank of England, the British Business Bank, in terms of providing liquidity to SMEs as and when it's needed and trying to pull back. And in fact, we do have a lot of conversations with the BBB and the BBI, and often they're trying to figure out how to have the right level of support for the economy. But this acknowledgement at the government level that because SMEs provide such a large proportion to GDP, they are critical and central to the economy. So that is so you continue to see support and will do over time.
Mm-hmm. And so there are a few things I think, Brian, from what you mentioned that really seem to resonate. I think one of them is mentioning that there'll be a lot more providers in the space, and the second is really around some of the comments that you brought up about SMEs. So in terms of SMEs specifically, what challenges or opportunities do you see for them going forward in terms of private debt and credit?
Yeah, well, I would say, someone said never waste a good crisis, because for business owners, if they can demonstrate that they have managed to handle this crisis quite well, that will bode very well for them going forward. So when we talk to investors, they like to see how businesses handle stress and challenges. So it's a good exercise in terms of demonstrating how capable the business is of dealing with that. I think on the inflation side, clearly we have a lot of issues around passing on prices to consumers, and the ability of those consumers to bear with those prices and actually to take on those. Because companies are clearly driven by profitability, and if the input costs are going up, and we have seen input costs of up to 25% in certain categories, if you're a business and you're dealing with those kind of input costs, you have to either declare challenges to what extent you can pass those on to your customers. I would say sterling, we should probably also comment a bit about sterling. So, we have seen sterling fall against other currencies, and what impact is this having on the SMEs? So I think that as with a lot of this stuff, there are positives and negatives. Clearly, a weaker sterling is very good for exports. So for those SMEs that are exporting globally, it demonstrates that that there should be more demand for their products. I think we also see that to some extent, with tourism. Tourism is actually an export as well. So when people come to the country because there's a cheaper currency, then the country basically can benefit from that. I guess the other challenge with a weaker sterling is that when you're buying your inputs from abroad, that's a kind of a higher input price. But also, I think that a weaker sterling can also lead to, a view to attract more investment into the economy, because they see it as being basically dislocated from a value proposition, and therefore institutional investors on a relative value basis can invest. And I think we've even seen, I guess I'm talking about the UK again here, is some acquisitions of companies recently because of the perceived undervalue. And I guess the things that just the continued adoption of digitization around processes is the thing that companies are doing to face these challenges. And the Kolleno product, which clearly is embedded in the systems of companies to proactively go out and manage the payments around invoices, is clear to supporting liquidity, supporting capital, making sure that the companies are doing the right things to be proactive and defensive against the challenges that we are seeing.
And I think just connected to that point, I know one element that you talked about, Brian, was just around invoices and the invoices and receivables. And so I wanted to talk to you a little bit about what you're seeing in terms of the collection and securitization of invoices as part of that.
Yeah, so thus far we haven't seen a big spike in arrears, across a number of our portfolios. There hasn't been a big spike in defaults, and that may be because there's additional buffers of support there, and or there could be a lag factor. So it can take some time for the full magnitude of these stresses to be felt at a company level. So that basically puts people on, as I said before, very proactively looking for deterioration in credit, because I think one of the key things that that are important during these times is to have very strong funding relationships, so that whether it's your bank or whatever funding lines that you have, you've got a strong relationship with your funder, because it's all about liquidity. You need to make sure that you have liquidity to kind of get through these types of crises. So around that, so basically lenders will look at your performance and your ability to track and highlight and proactively act against the deterioration of your cash flow, and that's a good thing. So once again, I think the digitization and using platforms that allow a higher level of efficiency and automation around this, and using artificial intelligence in a way that means that the people who are being chased for payment don't necessarily feel that it's a machine, it's more kind of a human thing, are all very good. Clearly, sector concentration is another thing. So large exposures. So we hear this all the time. lot of investors want to know, what are the top 5 exposures in the book, and even where they have insurance. If they've got insurance, trade finance insurance or something like that, they want to know what are the largest concentrations of those insurers of the underlying credit or receivables, because it's, once again, you're trying to identify the weaknesses and around what could happen, that tail end risk. So if you have a large default, what are those what are those specific risks that could lead to a problem in the business? So once again, using credit scoring, using other forms of proactive credit intelligence around the credit quality of the counterparties you're dealing with is very important. And then it's also very important to be able to, to take that knowledge, that dynamic knowledge as it changes into your business, because if you can identify a cohort of your customers that, may not be, you may want to change your business terms. I mean, fundamentally, you may want to go to cash cash on demand for certain categories of clients if you feel that their credit worthiness is deteriorating to a large extent. I know it's an extreme measure. It doesn't necessarily work great for business, but I guess that is what you need to do.
And Brian, there's 2 key elements that really stood out for me. I think just talking about risk and data and how digitization can kind of help support that. So Dimitri, maybe I'll hand it over to you to talk about I think those 2 themes really resonated. And really the first point is really around risk, and how do you see it as being approached from the perspective of SMEs and the conversations that you're having? What's top of mind for those leaders?
Yes, I mean, completely agree with Brian when he was discussing supporting having the right capital. So conversations that we have with business owners, there's 2 risk elements that is always looked at. The first one is we covered previously, the working capital, obviously be able to fulfill their obligations in terms of salary or purchasing PPE, all the equipments. That's one of the risks. The second one that we start noticing that came post-COVID is that clients is to retain and attract new clients. I think a lot of B2B relationships has been built over the years, and primarily face-to-face, and be able to travel and meet people in person. So I think this is business owners of companies, mid-sized companies, are primarily trying to retain and obtain new clients. This is one of the, I would suggest. And then they're always within the same category. Those clients are always, business owners are often hesitant to chase their clients when they're paying their invoices late. So I think this is one of the risks, is that it increases the level of DSO, and it's basically loses down the working capital in terms of days of outstanding receivables. And I think one thing, and it impacts also the customer relationship. So that's why at Kolleno, we've built a system through machine learning and artificial intelligence that decides the right tone of voice, the right channel, and the right content. So I think this is why a lot of those mid-sized companies, they enjoy using a platform that actually dictates them what will be, if they should use a text message, if they should use an email, or even send them a WhatsApp message, or using a phone call, for instance. And as Brian mentioned, it's also the concentration of those accounts receivables that matters as well. Very similar to what we do here, is if the client represents more than 10% of your portfolio, then the system will calibrate and adjust the right tone of voice and the right course of action. So I think there's 2 elements. Obviously, the business owners is retaining and obtaining new clients, and the second one is really the issue of the working capital and short-term liquidity.
Mm-hmm. And so we talked a little bit about risk. There was something that you said, Dimitri, that really resonated, just around the ability to kind of manage and be able to highlight some of the key elements that decision makers really need, right, to be able to make decisions. So from a data perspective, what are you hearing from a number of business leaders in terms of what they're thinking of from digital and how that's enabling them to get the data that they need to be able to manage those risks?
I think from a data perspective, a lot of data is spread across multiple platforms. I think this is what we're seeing at companies, usually between 4 to 6 different platforms within the CFO office. They're using an accounting system, they're using an email system, they're using a different communication systems. So it's in order to take the right decisions for the CFO office is to have one single truth and to have one single platform that it's a one-stop shop platform that centralizes all the informations. So I think having a real data life it's in a core requirement when it comes to cash flow projections. Having also a mostly credit insights when they onboard the new client, be able to actually look at those ratings of the liquidity of the client, of the potential client, profitability of the client, and indebtedness of the client in order to assess their viability to become a new customer and expecting to receive payments from them. So it's basically a matter of having this right decision tree when it comes to data, but the data that is available needs to be centralized and be able to translate that data into decision making and suggesting them the course of actions.
Perfect. And maybe, Brian, I'll just take an opportunity to talk a little bit about your perspective. You've touched on the importance of digitization to help kind of mitigate risks and data, and then be able to manage data. Can you elaborate a little more in terms of what you guys are doing and thinking through it at Crosslend on that?
Yeah, so I guess, if I go back to my time at, I guess even 10 years ago when I was doing funding transactions, very manual, like even putting together a pitch book for, to go out to a funder for a given business to raise money. You had to, it was quite analog in a lot of ways. You had to download loan level data from different systems. You had to then, manipulate it with Excel, create charts, and a lot of manual effort to basically, manage things. So I think, I'm just astounded at the level. I mean, I think Dimitri mentioned Slack earlier on, and, just the level of integration of apps and the level of efficiency that it brings to what we do and to the way the business operates is just brilliant. And I think that, Crosslend is very much sitting at the heart of that trend. What we've chosen to do is quite ambitious, because a lot of private credit debt and banking is kind of one of the last kind of areas to be truly disrupted. I mean, a lot of people say that the digitization of banking is only 1% done, so that leaves a lot of scope and a lot of opportunity. And so we basically, we are working with originators who will. We've got an open API onto their data. They're digitally integrated, and we're allowing those originators to share their historic data with investors. And sometimes that's in real time. So, whereas 10 years ago that data might have been 3 months out of date, we're then allowing those investors to be able to go onto our platform on a frequent basis, whenever they want, and monitor their portfolios that they funded. There's so we've built this platform which is accessible by institutional investors and originators to freely put their data up there. I think more and more institutional investors are looking at this asset class, predominantly because of its its defensive characteristics. So there's a lot of concern about volatility in the equity markets, and clearly bonds have had a really rough time recently with rises in interest rates. So I think asset managers are saying, well, if we just can have a sticky yield, a kind of a regular sticky yield that pays, then that's a good defensive play, and that essentially is what what direct lending and what cross the part of the market that the Crosslend is looking to play in. I think one other thing that is very there's two other major things that are happening. One is around embedded finance. So embedded finance is the combination of really cool technology with a funder being there at the same time. And there are lots of different players in this space, and lots of different companies who are trying to be part of it. But just the just the level of efficiency, when you think we go back to the analog days of people writing check and changing standard orders and going into banks and all that kind of stuff, whereas now literally it's I think when people are analyzing the UX, the user experience around embedded finance, it's like, how many clicks did it take to get the power drill? How many clicks did it take to get the office furniture? Have you, in terms of did you get the funding at the same, and is all that kind of competitive? I think the other thing that we're seeing is around subscription finance. So the whole SaaS subscription models are, very much to the fore. And once again, that's another thing that we're very much a part of. So, but it's challenging too, because not all companies are up to that level of digitization. So, people have different levels. It's the spectrum of ability, and I guess that does lead to the question. If you don't digitize as a company and you don't embrace technology, does that mean you're less competitive, or is there a threat from other parties to the part of the market that you're working in?
Perfect. Well, I think on that note, what we'll do at this point is open it up to the audience. I know we've got a number of different attendees, and so we ask that the audience, feel free to put forth some of their questions for our speakers. And in the meantime, what I will ask Brian and Dimitri is, we've talked about digitization, we've talked about data and risk, and how it can help to provide those types of opportunities to manage those elements and provide greater visibility, greater kind of risk management for businesses and investors. But where do we go from here? So Dimitri, maybe I'll start with you. As we're going through this and navigating through this economic climate, where do we go from here? What would you advise businesses as they look to the future?
I think there's a few elements, Gibran. I think Brian highlighted very clearly is that we obviously came from the analog days, and transformation or digital transformation wasn't taken seriously enough pre-COVID time. And then once COVID hit it, people, it was more of a wake-up call. And I think what we see across different industry or even business leaders that we speak to, obviously we highly suggest I would suggest CFOs, C-level to embrace digital transformation. As Brian mentioned, there'd be a pressure. A lot of companies who are not embracing digital transformation, there might be a competitive pressure, barriers to entry to the market, or even lagging behind when it comes to cost efficiency. And one thing that we've noticed also, there's still people who are lagging behind, and they're like hesitant to it's often on their roadmap, but they say occasionally it's not for today. And the typical sentence or the typical mindset that we're often using is that it's nice to have a roadmap for tomorrow, but we need to ensure that we have a road to travel today. And I think that's something is critical, especially for the new generation of companies when it comes in e-commerce or any other industries that hasn't taken seriously implementing all the right channels across all the divisions.
And thanks, Dimitri. And same question goes to you, Brian. So where do we go from here? What opportunities do you see as we go forward?
Yeah, so I think that companies' growth and economic growth will clearly be linked to digital transformation. I think there's I think that the two main some of the main areas that we need investment in the economy around the green initiative, the decarbonization energy efficiency. So I think companies need to look both at how they how they operate themselves in terms of their own internal costs. And we've had this energy shock price, and I think people now realize that they need to focus a lot more on sustainable energy or securing energy supply. Because clearly in the manufacturing sector, the idea of energy rationing is just unthinkable, because that's really core to your ability to perform as a business. So I think there are clearly a lot of opportunities around investment opportunities around that, both internally and externally for companies. I think in terms of giving advice to business leaders in this current environment, I would probably say, always have very good relationships with your funding partners. Likely have more than one. Don't be beholden to one or two. Make sure you got good diversity. It's always good to have a buffer in the business, good contingent liquidity. That basically the business can withstand a period of stress. And once again, that really comes down to all of the factors that we've mentioned around being proactive around the risks and sector concentration. And I guess the other thing is that in times of stress, there are opportunities, but it also may be a time to be defensive, not to expand for that certain period. So obviously over the next few months, there's until we see how the various extraneous factors come together. It may, a note of caution from business managers may be the best strategy.
Perfect. And with that, we do have a few questions coming in here now from the audience. So maybe we'll start with our first question from David. And so, given the budget constraints that many of us are facing, he's wondering, where should he be investing his capital to digitalize his business? So maybe, Brian, we'll start with you, and any thoughts around that digitization process. This is a question we often get, is where do we start? Where do we actually invest? As we look forward.
Well, I think there are two answers. I would say you invest where you can reduce costs, and you should invest where you can grow revenue. So I think I don't know the nature of the business that David has, but I think that and costs are different. You can measure costs in different ways. Your own time, spending time, C-suite management time on something that could be automated is clearly a cost saving, because then that time can be used better elsewhere. So I think to basically look at the business, look at the range of different automations that can be done to in terms of managing, controlling, reducing costs, but then also in terms of going out to grow revenue. Interestingly, over the last couple of years, we have had we work with a number of companies who use things like AI digital marketing, and this is where one of our clients was in the kind of building and construction industry in an EC country, and they had a kind of a crawler package that basically tracked all of the submissions for planning applications all over the country, and they're able to kind of take all that data in and then go identify the people who were those companies who were engaging in the construction, and then target them for the particular business that they were in. So so I think those two areas would be my recommendation.
And Dimitri, maybe I'll hand it over to you. Same question. Given the budget constraints, where do people prioritize? Where do they invest?
Well, I'll recommend David to explore Kolleno.com. Obviously, on that side, I think completely in line with Brian. I think platforms that solves the cost, for instance, be able to increase their efficiency, but platforms also who have direct impact on the top line and revenues in order to retain clients, for instance, and customer satisfaction. And then that's the core element, as Brian mentioned, is really how do we reduce this cost, but how do we become more efficient at what we do? and then retaining the same level maybe of talent, but becoming more efficient and increase the level of output when it comes to production. And then also be able to retain client. I think client relationship is key these days. Is not only being a digital with them, but also be able to respect their own time, their own environment, and be able to communicate with them with the right appropriate tone of voice, right channel, and be able to adjust also the frequency. So a lot of business leaders they want to make sure that in order to retain clients, it does require them to maintaining that relationship, and that's core element. I think we've seen most recently this morning that WhatsApp has partnered with Salesforce. So it's interesting to see that WhatsApp for Business will become the #1 communication in the United States for all the businesses. So you go to your dry cleaner, you can communicate with a dry cleaner on WhatsApp for Business. You can make a reservation for a restaurant on WhatsApp for Business. So I think it's, embracing digital transformation will move from the consumers and will shift to businesses, because ultimately businesses are the day-to-day consumers, people. So I think that's where we always forget businesses are run by people for people, and this is where we see the next trajectory in the next 5 to 10 years.
That's great, and I think we had another question that John that came in from John that really touched on one of the topics that you mentioned, Brian. Which is really the fact that I think for a number of business leaders, there's concerns around the current economic uncertainty. Where do things go? And I know, Brian, that you've written quite extensively on the financial crisis and the impacts of that on the private debt market. So, what parallels do you see? What differences do you see? Based on that, as businesses have some concerns about what's ahead.
Yeah, I think that fortunately we touch wood, we're in a much better situation than the great financial crisis, which was a very, very severe economic stress. I mean, you're talking about a situation where the Fed had to essentially bail out a number of banking institutions to keep the economy going. So I mean, I think that the regulatory measures that have gone in since then clearly are mitigant to that, and then also all the succession of liquidity measures that came in post financial crisis, whether it's the ECB, the ability to repo assets or repo instruments, or even in Germany, people like the KfW will just provide unlimited cheap support to SMEs, and similarly in the UK you have these borrowing schemes. So I think that it's brilliant that in the period after the financial crisis, the policymakers and the various participants have put in place a good toolkit. So they have a good toolkit. They have a good crisis toolkit. I wouldn't necessarily agree that they have as good a growth toolkit, because I believe that that there should be more liquidity provided at certain specific liquidity at certain levels. That to act as a catalyst to help SMEs grow. So I do believe that I think that the companies need to kind of broaden out their funding, and often they can't. They need to have a good track record of funding. So I do think that the British Business Bank, BBI, and the ECB and EIF and other agencies should look at better ways to get cheaper funding into SMEs, particularly those that are kind of on a more marginal basis. So then I guess the question is that because after the crisis you saw this huge amounts of defaults in portfolios. So the PD or the actual defaults were quite large, and that also brought on another kind of component, which were parts of the private credit market that came in to buy NPLs. So the good thing is that even if companies get into trouble, there is capital there to enable companies to restructure, and also to prevent them from going into insolvency. So there's to some extent there are better safety nets around. And I think that also applies to, when companies are selling defaulted receivables. I think the digitalization of all everything to do with investment has also kind of made companies better able to determine which are good credits and which are bad credits. Unfortunately, I think for the banks, it means that they're a bit barbell, or they've only one side of a bar, in that they generally only want to fund the really good credits, which means that the kind of private credit industry is looking at the others. So I think that we've learned a lot of lessons. There's been a lot of things put in place, and I think if things get worse, you will see some of those bazooka measures being deployed, but hopefully that won't be the case. And clearly the energy price caps for both at a retail level and a corporate level are a clear example of that, where the government is coming in to basically soak up the additional expenditure. So,
and I think that's a great segue. I know we've gone through the questions from the audience. I think that's also a great segue to another webinar that we'll be hosting next week with our economist Richard Diaz. And so, for all the participants on the line, we do want to say, first of all, thank you for joining us. Secondly, thank you, Brian, for joining us and sharing your expertise. Thank you to Dimitri. We look forward to continuing to engage the audience. Please keep an eye out for our upcoming webinar next week with Richard Diaz, where we'll be touching exactly on the points that Brian mentioned. So thank you all. Really, really do appreciate it. And following this, we'll also be sending out a recording to participants, and look forward to continuing to engage in these discussions.
Thank you, Brian. Thank you, John.
Perfect.
Thanks, John. Thanks, Dimitri.
Thank you, everyone.
Talk soon. Bye-bye.